What if I told you a strong economy doesn't guarantee a strong stock market? It sounds strange, but history proves it. Some of the biggest market crashes happened when the economy looked perfect. Low unemployment, glowing headlines, everyone optimistic. Yet the floor can drop out when you least expect it. Today, I'll break down 5 reasons why a booming economy can actually be a warning sign for your portfolio. Let's dive in and uncover what most investors miss. The stock market is a forward-looking machine, always scanning the horizon for what's next. It's not just reacting to what's happening right now, it's constantly trying to anticipate the future, making bets on what's likely to unfold months down the line. That means it cares far more about tomorrow's possibilities than today's headlines. Even when news breaks or economic data is released, the market is already thinking ahead, often moving before the rest of us even notice. When you see record GDP numbers or hear about low unemployment, remember, the market likely priced that in months ago. By the time the good news is public, investors have already moved on to what's next, searching for new signals and trends. Investors buy stocks based on what they expect to happen 6 to 12 months from now, not what's happening today. Their decisions are shaped by forecasts, predictions, and the potential for change, not just current events. That's why markets can sometimes rally even during a recession, because investors believe the worst is already behind and better days are coming. Or, the market can fall even when the economy is at its peak, if investors fear that growth is about to slow or that trouble is brewing just out of sight. When growth slows or expectations dim, the market reacts quickly. Even if the economy still looks strong on paper, it's always one step ahead, adjusting to new realities before they're obvious to everyone else. This creates a disconnect. Main Street might feel confident, with people shopping and businesses booming, but Wall Street is already preparing for what's next, sometimes heading for the exit before anyone else sees the signs. The party isn't over yet, but the smart money knows it's almost last call. In the world of investing, being early is often better than being late. Booming economies breed overconfidence. When markets are soaring, it's easy to believe that the good times will never end. Investors, fueled by headlines and success stories, start to think they can do no wrong. Everyone thinks they're a genius investor, convinced that their picks are destined to keep climbing. Social media buzz and group chats only amplify this feeling as people share stories of quick profits and easy wins. This collective optimism pushes stock prices far above their real value, inflating bubbles that seem unstoppable. The fear of missing out drives even more people to jump in, chasing the next big thing. People stop asking if a company is worth the price and just chase last month's gains, ignoring warning signs and fundamentals. Rational analysis takes a backseat to excitement and hype, but when prices are sky high, even a small disappointment can trigger a massive sell-off. Suddenly, confidence turns to fear, and the mood shifts in an instant. The same herd mentality that drove prices up now causes panic selling, as everyone rushes to get out before it's too late. The crash isn't about a bad economy, it's about prices finally snapping back to reality, correcting the excesses of unchecked optimism. Overvaluation makes the market fragile, and reality always returns, reminding us that markets, like bubbles, can only stretch so far before they burst. Central banks, such as the Federal Reserve, play a crucial role in managing the economy's ups and downs. When the economy is running hot and inflation starts to rise, these institutions step in to cool things off, most often by raising interest rates, which is one of their most powerful tools. Higher rates make borrowing more expensive for everyone, businesses, homeowners, and consumers alike. This means loans for new projects, homes, or even credit cards cost more. As borrowing costs rise, profits get squeezed, and investors start to look for safer places to put their money, like bonds, which now offer better returns compared to riskier stocks. This shift causes money to flow out of stocks, putting downward pressure on share prices and sometimes triggering sharp declines in the market. Even if sales remain strong, the rising costs from higher interest rates can eat into company earnings, making it harder for businesses to grow or even stay profitable. In fact, many market crashes don't begin when the economy is shrinking, but rather when central banks decide it's time to hit the brakes and slow things down. In this way, interest rates act as the market's silent wrecking ball, powerful, often unseen, and capable of reshaping the financial landscape almost overnight. Strong GDP doesn't guarantee strong corporate profits. At economic peaks, companies face rising costs, higher wages, pricier materials, and more competition. Even with record sales, profit margins can shrink. The market punishes any earnings disappointment, no matter how small. So, a company can post record revenues, but see its stock plummet if profits miss expectations. The pie gets bigger, but more people are fighting for a slice. The market only cares about earnings per share, and surprises are rarely forgiven. The market is driven by human emotion, greed in booms, fear in busts. When prices fall, fear spreads fast, triggering a stampede for the exits. Headlines turn negative, and selling becomes contagious. Most people follow the crowd, buying when others buy and panicking when others sell. Logic disappears, survival mode takes over. This herd behavior turns small corrections into full-blown crashes. Confidence built over years can vanish in hours. Crashes are fast, violent, and fueled by psychology, not just numbers. The real lesson? Strong economies often set the stage for crashes. Booms create overconfidence, high valuations, and the conditions for a fall. The market is a leading indicator. Watch expectations, not just headlines. Successful investors stay disciplined and don't follow the herd. If this changed your view, hit like, subscribe, and comment. Markets are forward-looking. Thanks for watching. See you next time.